In our previous videos, we have covered a possible economic disaster occurring in China. However, some shreds of evidence point to the fact that a recession has already occurred. Join us in today's video as we examine the factors that have affected China's economy.
Recessions normally around the corner. That's why many people in the markets and many economists say it is possible.
A massive protest over frozen bank deposits turned violent in Zhengzhou in China. Police clashing with demonstrators on Sunday, demonstrators who were angry that
China's slowing growth in a country where youth unemployment stands at a staggering 19%.
It's just an incredible story what's going on in China as it tries to tamp down on a COVID outbreak, as the White House today marks the loss of 1 million lives to COVID here in the U.S.
The big concern is really what lengths the Fed is going to go to at this point to curb inflation.
No one can deny the fact that China's economy is currently in a state of collapse. China has instituted the world's most severe COVID restrictions. That, however, is only the beginning. The credit market is disintegrating, housing sales are plummeting, the stock market is plunging, the Chinese yuan is being devalued, and social upheaval is breaking out. A conventional recession isn't what's going on in China at the moment. It is the most significant decline in the value of real estate ever recorded, and it poses a considerable risk to the economy of the entire world. For every economy, consumers are the engine that powers economic growth forward. This is the worst time ever for Chinese consumers, and we're not lying. The present reading on China's Consumer Confidence Index, which stretches all the way back to 1991, is the lowest it has ever been recorded in the whole existence of the index. This is really dangerous because it creates a frightening cycle. The money that one person spends is the money that another person receives. Thus, if people don't spend money on items, then others don't get paid. Suppose an employee of Didi spends less money on Alibaba.com. This results in lower profitability for Alibaba. This results in layoffs and salary reductions among Alibaba's workforce. As a consequence of this, less money will be spent on the goods of another company, which will inevitably lead to a further reduction in income. If you are a citizen of China, you should be quite concerned about the current situation. The fact that the government is to blame for the nation's faltering economy is the most disappointing aspect of the situation. The Chinese government's Zero COVID program, which aims to reduce the number of COVID instances to zero, has completely wrecked the country's economy. The Chinese government's ultimate objective is to have no new instances of COVID. When you consider that China's population is currently at 1.4 billion people, it is obvious that this cannot happen. This explains why autocratic administrations sometimes make poor decisions. When the government sets an unrealistic goal, such as eliminating all instances of COVID, it will implement all laws necessary to achieve it. Citizens are required to have a negative COVID test within the last 72 hours in order to engage in nearly any activity. A train ride, shopping, and a meal at a restaurant are among the things we're discussing. All of the above need a negative COVID test result. This wouldn't be a problem if being tested wasn't such a hassle. But when there are 16 million people in one city seeking to get tested, it shouldn't come as a shock that the testing queues are so crowded. Therefore, due to COVID testing requirements, individuals cannot go shopping. They can't visit their relatives. Some individuals are unable to work. This is frightening on its own, but the imposition of lockdowns makes the situation even direr. After a COVID outbreak, the whole city of Shanghai, which is home to 26 million people, had to be locked down for 70 days. Some may believe that the lockdown has been lifted. However, the COVID restrictions are still in effect. Because of a single COVID incident in Shenzhen, significant areas of the city were subjected to widespread testing. People in entire communities could be required to take a test because of a single case of COVID. Strict rules like this are out of control. The continuing decline of China's property market might be one of the most catastrophic consequences of the COVID lockdowns. One of the most colossal bubbles in existence, China's property market is so enormous that some question how it came to exist in the first place. Putting money into investments is something that every citizen should prioritize highly. Everybody hates to see their savings get slowly reduced over time by inflation. Consequently, the average person may examine the stock market. However, Chinese stocks are particularly dangerous. Just as a direct result of the CCP's actions, the value of Chinese ride-hailing companies such as Didi, the country's largest, has dropped by 75 to 90%. As a result of the government's decision to take over what was formerly a privately held company, the education sector lost its whole $1 trillion market value overnight. After being missing for an unexplained period of 3 months, the reputation of the Chinese business prodigy Jack Ma was shattered. China's government made problems worse by maintaining the danger of a delisting on the US market in place. These hazards associated with a declassification are only going to continue to increase as time passes on. Therefore, investing in stocks is not really a viable alternative for people living in China. How about other resources though? The great bulk of other assets cannot be invested. Consider Bitcoin, which in 2021 was subject to a countrywide prohibition. People in China have no choice but to invest in property. This is problematic because there is an excess of capital competing for a shortage of investment opportunities. As a result of the lack of investment options for Chinese citizens, a property bubble has emerged. To expeditiously broaden their real estate holdings, property developers have resorted to enormous amounts of debt totaling billions of dollars. In their minds, taking out a loan makes sense. The price of Chinese real estate has risen steadily over the years, with hardly any dips. The accumulation of debt has been going on for such a long period of time, and the government has actively supported it throughout. And the magnitude of the bubble only grew as long as the government encouraged the growth in debt. In China's so-called ghost cities, 65 million unoccupied residences can be found. Residences located in these cities are only there as investments. The lack of occupants is due to the fact that the vacant homes exist solely for future earnings. Until recently, investors were planning to pass on the properties to successive generations. The CCP has decided to purposely crash the markets, as the government is free to do so whenever it pleases. Recent remarks by President Xi have belittled real estate investments as if his encouragement for them during the past decade was unfounded. Xi has been putting into effect what is known as the 3 red lines in an effort to rein in the real estate industry. These 3 red lines place a limit on the total level of debt that real estate developers are allowed to carry. If a real estate developer breaches 3 different red lines, then further debt expansion is allowed at the rate of 0%. Since many property developers must figure out a way to pay their interest charges, this is a huge problem for them. In the past, businesses such as Evergrande would simply take on additional debt in order to pay off their existing interest. However, this is no longer possible. Evergrande is not allowed to take on any more debt because they have already surpassed all 3 red lines. Selling real estate to pay off debt is the only option available. However, who will acquire the properties? There is no way that real estate developers can, considering that they are all frantically attempting to push to the 3 red lines. In addition, nobody is interested in purchasing real estate in a market where the CCP is deliberately collapsing the market. Many Chinese real estate developers are on the verge of going bankrupt. Moody's research categorized the bonds of 3 Chinese property developers as having a high likelihood of default during the Asian financial crisis that occurred in 2009. This quantity has been raised to 24. The housing bubble was not something that suddenly materialized out of thin air. It's a product of decades of mounting debt. Between the years of 2010 and 2019, the amount of debt held by the real estate industry climbed to more than $1 trillion, from a previous level of $100 billion. Over the course of 9 years, the company's debt has increased by a factor of 10, making it unsustainable. In an attempt to boost the property market, the Central Chinese Bank has slashed mortgage rates, although it hasn't been very successful. If lending rates were lowered in an already heavily leveraged market, It would be like feeding someone with diabetes some chocolate. Existing measures taken by the government have simply served to exacerbate an already critical issue. Nearly the past year, there has been a decrease of over 41% in residential building sales. This shocking decline is exceptional and surpasses those of 2008 and 2014. According to Nomura Holdings, one of Japan's largest financial institutions, the current property market decline is the worst ever. Similarly, the number of Chinese developers who have had their ratings lowered is at an all-time high, with ratings being lowered even as we speak. It's impossible for real estate developers to get out from under their mountain of debt. Even those that fall below the 3 red lines have little chance of success in a setting such as this one. So, what's the big deal here? As was indicated earlier, the sole type of asset class available to Chinese residents for investment is real estate. Experts estimate that China's real estate market is worth $55 trillion, roughly 3 times the whole annual gross domestic product of the United States. Approximately 28% of China's overall GDP is accounted for by real estate and related industries. A decline of 50% in the value of the real estate in China has the potential to trigger a global economic downturn. China contributes more than 18% of the world's gross domestic product. If the Chinese economy begins to decline, this may lead to an overall weakening of the world economy. Some people may have the view that China's economic slowdown would only last for a short period of time. It's not totally correct though. It's not the real estate market that's crumbling in China. The amazingly rapid GDP growth in China has some economists in awe, but they have failed to recognize the underlying problems that have been produced. The whole expansion of China's economy was driven by a significant rise in the country's debt levels. It used to be that China had a comparatively low amount of debt, but now the country's overall debt is nearly 4 times its GDP. As a direct result of China's excessively high debt levels, the debt market is already beginning to have difficulties. Because of the current state of the economy, lenders are reluctant to lend money. A 5-year low has been reached in China's lending volume. This is a desperate effort by the Chinese central bank to persuade lenders to increase lending, but the economic picture is just too gloomy. The decline of the value of the Chinese yuan is directly attributable to the accumulation of all these economic challenges. As a result of China's ongoing economic woes, the Chinese yuan is currently experiencing the most severe devaluation in the currency's long and illustrious history. In contrast to the US Federal Reserve, China's central bank has been decreasing interest rates as quickly as feasible. Due to a lack of room for interest rate increases, the Chinese economy will not benefit from quantitative easing in 2021 like the US economy did. Recent events have resulted in a significant rise in the rate of exchange between the Chinese yuan and the US dollar. The yuan to dollar conversion rate is depicted in this graph. In other words, the graph here illustrates how much money you get in yuan for every dollar you have. That abrupt depreciation in the value of the Chinese yuan is clearly visible here. In a short span of time, the yuan to dollar exchange rate rose from 6.4 to 6.6. This indicates that you will receive 0.2 additional yuan for each dollar compared to what you were receiving previously. Even though it doesn't look like much, this has been the worst month ever for the yuan. 2015 was the last year in which a rapid, massive depreciation occurred. This occurred at a time when many people were beginning to question China's commitment to the free market because the exchange rate of the yuan had been purposefully manipulated in order to support the Chinese economy. China's currency lost $1 trillion as a result of the financial crisis that swept the country in 2015. Because the value of the yuan is currently falling by an amount that is much greater than what it did in 2015, we may find $2 or perhaps $3 trillion worth of capital leaving the yuan. Chinese authorities have tolerated or even urged the devaluation of the yuan since doing so helps the economy short term. Chinese goods are becoming more affordable as the yuan weakens. For instance, if the United States dollar can be traded for a greater number of Chinese yuan, then a greater number of people in the United States will buy items manufactured in China. The problem with devaluing one's currency is that it will have a negative impact on economies that are driven mostly by exports. In 2015, India's currency fell to a 2-year record low as a result of the country's export competition with China. Due to the fact that developing markets are primarily reliant on exports, a devaluation of the Chinese yuan might drag the entire emerging market down along with it. This sets the groundwork for a huge economic disaster, much like in 2021 when the US Federal Reserve began printing more money. The Chinese government is well aware of this fact. However, much like with a medication that causes addiction, they are unable to resist stimulating the economy. There were 33 additional measures included in the latest stimulus package released by China, totaling $5.3 trillion. This is much more than the whole stimulus budget for 2021. If you analyze the stimulus plan, you'll see that 26.7 trillion yuan in general budget spending makes up most of the finances. China might tell us that these expenditures are for a short COVID outbreak. Nevertheless, they are only attempting to mask far more severe problems by doing so. Many of you who are not citizens of China may believe that your lives are safe from China's downfall. However, this is not the case. China likely manufactured the gadget you are using to view this video. China is the world's second largest manufacturer, with a share of global manufacturing output of 28%. An abrupt downturn in both the global economy and China's will place a significant strain on manufacturing industries everywhere. With a diminished supply of commodities, prices throughout the world will increase significantly. Europe will suffer the most severe consequences of all. China is the primary supplier of metals to the European Union, which means that Europe must rely heavily on China. China is responsible for somewhere between 75% and 100% of the overall supply of metal that the EU receives. China is the primary source for 19 of the world's most important raw commodities, out of a total of 30. Magnesium is a good example of this, as China is the source of 98% of the EU's magnesium supply. Consider the consequences if 70% to 90% of the metal supply were to disappear overnight. The costs of essential commodities will increase, putting additional pressure not only on the EU but also on other economies. What do you guys think of China's collapse? How do you think it will affect the rest of the world? Share your thoughts in the comment section down below. If you enjoyed this video, please like and subscribe, and we'll see you on the next one.